concentration of market participants. What effect does this have on overall competition and innovation? We may never know for sure, but today there are half the number of broker-dealers and far fewer market makers as 30 years ago. That's directly attributable to costs of doing business, including the costs of meeting regulatory obligations. Firms are locked in a high-tech arms race for speed, directly attributable to provisions of NMS as well as customer demand. When regulation is inefficient and causes distortions, that necessarily raises costs and drives competitors out of the market. A market regulator like the SEC must question what increased concentration means for the stability of the markets and the financial system overall. Has it pushed trading facilities towards increased homogenization and driven exchanges in particular to try to differentiate themselves in ways that do not necessarily enhance an issuer and investor choice or serve their interests? Last, the SEC is now gatekeeper for approving data fees, which are lightning rods for increased costs to market participants and significant litigation. The monopolistic market data regime that the SEC has allowed to develop, including through the NMS regime, is yet another driver towards market distortions, increasing costs, and the resultant concentration of market participation. For best execution and to meet customer demand, a broker-dealer must pay prices that are not set by market forces. So given some of the volatility in the capital markets that we've seen recently, as well as emerging retail investor trading platforms, there's an opening for the SEC to do what it should have done 15 years ago and take a comprehensive view of equity market structure. This review should be part of a formal rulemaking process include a hard look at Reg NMS and its effects on the prescriptive approach that it's had on the markets, including outright removal, outmoded Rule 611. The last such detailed study was the Market 2000 report that began in 1992 with a market regulation division concept release under Chairman Breeden and concluded with a report that was released under Chairman Levitt in 1994.
This is going to go on
So
for
in
hours
taking
in the
such an
probably
assessment, the SEC will fulfill the worthy goals set
at
forth
least
in its mission
4:30 or
to oversee fair, orderly, and efficient markets. Hope I hit it on 7 minutes. Thank you very much.
On the dot. All right, Sal, if you're ready to go, please go ahead.
Yeah, thank you, JW, and I'm sorry about that. Can you guys hear me now? All right, perfect. So I want to thank you all, and I don't know where I cut out, but BestX has defined my role in the financial industry for my entire career, dating back to my early 1990s employment at Instinet, the world's first electronic broker. I've worked as an agency institutional broker well before Reg NMS was ever conceived, in a quote-driven market, with a single ECN added in, then two, then half a dozen. I've also worked for 2 decades at the firm I co-founded with Joe Saluzzi, Themis Trading, in a post-Reg NMS order-driven market. My entire career has been dedicated to serving institutional money managers representing the overwhelming majority of long-term investors in our markets that we are charged to serve. Best execution is an evolving and complex concept. How it applies to a retail order of 12 shares of, for example, Palantir is very different than how it applies to a money manager's order of 500,000 shares of Palantir. The key to BestX for the retail 12-share order is an execution consistent with real-time market conditions against actual available liquidity. Terms like price improvement and the national best bid and offer are commonly used, but there are problems with those terms. The NBBO is typically thin for most stocks, and using it as a benchmark for BestX doesn't account for available odd lots, hidden liquidity within the NBBO, and the NBBO is also stale. There's 2 price feeds, or there's actually, an infinite number of price feeds if you really get into the nerdiness of it. There are many views of the markets, and exchanges make massive amounts of money selling speed and access so that there is a built-in arbitrage subsidy between real-time views of the market and an ever so slightly stale public view of the market. The key to my achieving BestX for my larger investors is a different matter. My achieving BestX for my clients depends on how well I can source liquidity in a fragmented web and mitigate price impact, which we try to do by being unpredictable and controlling the degree of interaction with very short-term traders. My performance is typically measured by how much am I affecting the stock price, since it is unlikely my client can buy 500,000 shares of anything within the confines of a thin crust NBBO, an NBBO that presents enough challenges as it is for retail orders. And to illustrate, I've included a chart, and it happens to be a liquidity profile of Palantir. And you'll see that over 50% of the liquidity is executed by a handful of high-speed firms off exchange through bilateral payment for order flow relationships and captive order flow. All exchanges together trade about 43% of the order flow. All dark pools together trade about 5%, with UBS the largest at 1.2%. Now, where should I trade my client's 500,000 share order? On IEX, on the New York Stock Exchange, in UBS's dark pool? Should I start a bilateral relationship with Citadel, where they know that every time I send them a part of my order, a child order, there's usually stock behind? Should I use a systematic, predictable algorithm like VWAP? What percentage of volume participation rate should I aim to execute at? At what price level should I be aggressive? At what price level should I be extremely passive? How do the above destinations treat my client's order when I rest there? Where should I rest first? Last? What order and matrix should I route in? Am I being predictable? What is a natural amount of expected price impact for my order? How I deal with the above questions is how I achieve best X for my client, and the situation differs for every stock every single day. Defining best X in the institutional world I operate in is not simple at all. Heck, it's not even simple in the retail world, as the meme stock craze lays testament to. Perhaps because of the complexity of our modern markets, Themis has always believed the best way to regulate the right thing and fairness is by eliminating conflicts of interest where possible. Banning payment for order flow, PFOF, is one principle we've urged our regulators to adopt going back at least a decade. It would elegantly guide our equity markets to a natural state of supply and demand, a natural state of price discovery and proper market fragmentation in a way that specific and complex rule writing could never do. Banning payment for order flow in dark and in public markets would result in public markets that are more diverse, with participation from market makers, prop traders, retail investors, institutional investors, value players, growth players, everybody. And those diverse public markets would be deeper and more robust in good times and in times of market stress. Banning payment for order flow would greatly reduce the segmentation that is occurring currently for the benefit of a few firms and at the expense of investors. I look forward to answering any questions you may have for me today. Thank you.
Thank you, Sal. All right, Ty, you're up next if you're ready to go.
Yeah, thanks. I appreciate it. Thanks, commissioners, members of the Investor Advisory Committee. Healthy Markets obviously appreciates this opportunity. And I just want to point out, because we are hearing a lot of discussion about investors, our members are in fact pension funds, investment advisors, as well as some broker-dealers, exchanges, market data firms. And we focus on the plumbing of the markets. And I just want to begin by frankly endorsing a lot of what Sal just said, and frankly what we heard earlier today from the commissioners, and frankly what we also heard in terms of the observations of some of the problems. Although I think solutions we might differ a fair amount, but former Commissioner Atkins, I thought, nailed some of the really concrete problems that we're facing. You know, perhaps one of the greatest opportunities actually the commission could face to improve the plumbing of the markets is to answer one simple question for investors, which is, are my service providers getting me the best prices? And what does best execution mean? And is it really best price? But let's back up for a second and start with where we are today, which is we are here, and this stuff is in the news because it's easier to trade more complex, risky financial products than ever before. And the explicit trading costs are lower for retail and institutional investors than they've ever been before. My 16-year-old babysitter can trade single contract call options on an app at a traffic light. And by the way, she does. we'll set aside the regulatory implications of that. But we have to recognize that more women and minorities are coming into the market in the retail place at record levels, and we should be welcoming them to our capital markets. On the other side of things, though, we do have some things to worry about. Right? We're seeing extremely volatile prices. We're seeing things that are disconnected from fundamental value, right? And when we read a recent offering of securities from AMC, and their own disclosure said this is probably not a good place to spend your money. That's a weird thing to see when we have a capital market system that is seeing these sorts of wildly volatile swings. And the commission's role, and I would argue the IAC's.
Let me just jump in for a second here just to point out my opinion on this whole matter here. All right, Adam Aaron tweeted about it or whatever yesterday. I did see the tweet, but a lot of the apes are just jumping to this conclusion that they have all kinds of conclusions. Retail owns over 98% of the float, I guess, or of the shares outstanding. You know, there are 501.78 million. They went on to say, as of, I don't know if anyone can read this. We don't have a good resolution. Okay. All you have to do is pause my video later and just read this. Yeah, that's it. There are approximately 4.1 million, sorry, because I'm hearing the video myself, and another video on my headphones, so it's distracting me. As of June 2nd, there were approximately 4.1 million, this information as reported, blah, 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 individual shareholders eligible to vote at the upcoming shareholder meeting. Obviously, Adam Aaron just like copied and pasted part of this and to this quote, I think. I have to check if that's true. I'm just guessing that's what he was doing. AMC's definitive press. So people are misinterpreting. There were approximately 4.1 million individual shareholders eligible to vote at the upcoming shareholder meeting. I believe that's including institutions. Every institution is counted as an individual, which makes sense if you think about it. How many shareholders, individual shareholders, do you really have? Most people are using brokers, and then plus the institutions. Add up all the brokers and institutions out there, and those who are bona fide just individual people on the board of executives or what have you. Those are individuals who hold shares that are eligible to vote at the upcoming shareholder meeting. Doesn't include shorts. Shorted shares do not have voting rights. People with short positions don't have voting rights. I mean, if it's exclusively short and it's on equity or whatever. Advanced voting will begin June 16th. Okay, so that's great. By the way, expect to have to wait all the way through. Oh, sorry about that. Have to wait all the way until the end of the month, essentially here, midnight. So July, if we have a July 29th, you can vote all the way through July 29th. It's weeks and weeks out. They're not going to be putting out anything, I don't think, or much of anything until that's done. Then let me just read the CEO's comment here. He said the number of investors who want to own a part of AMC continues to increase and now stands at approximately 4.1 million. More than 80% of AMC's shares are held by a broad base of retail investors with an average holding of around 120 shares. Period. Next new sentence now. Some hold more, some hold more, some hold less. Again, that's an average. We don't know where that comes from. We can assume it's the proxy service, the proxy intermediary. So none of this, when you apply, first of all, you can't take this 120 as an average and then use that to figure out the total of anything, because that's an average. Okay, mean obviously is average, and then you have median, which is in the middle, and then you have mode, which is different. And I honestly don't even remember. I'm not gonna lie, be like one of those people who streams and says acts like they know things that they don't. I don't understand the entire all financial institutions, but I do know that when it comes to naked short selling, when it comes to naked shorting, best way for AMC to actually figure out if they're being naked short sold, they have incentives, by the way, to not want to figure that out because it could decimate them if they were to just say, hey, we're being naked short to all hell. If they just came out and said that, well, the value of their stock goes down, guys. A company that's being advertised as having been raped by naked short sellers does not increase in value. It doesn't help us squeeze either. It does not help us squeeze. Okay. That's my opinion now. My friend Galactic Finance, Jack, he disagrees. He's on with his own stream right now. If you want to check him out, Galactic Finance. If you just want to kind of watch the stock. I kind of lost my train of thought, but I mean, okay. And if you look at short interest on here, I mean, yes, like look at the short squeeze score, right? 100. Yes, it's at 100, but how long has it been at 100? So in my opinion, this thing squoze. There's your price. All right, there's your squeeze. Anything, we continue to step down. I mean, there's no reason to expect another one, but that was it right there. That was it. Could have taken profits right there. Yeah, maybe we'll get another push up. There's so much hype around the stock now. I don't have any interest in lying to people either. I'm just giving my opinions. So don't have a position on AMC. I'll trade sometimes the ES here. As you can see, this is on a paper account. E-mini S&P 500, gold. I made a good amount on gold this morning. So that pushed higher, and I it's hard to tell, like, where's it going to go from there. Down 10.92% now. It's just AMC. Okay. This is AMC. All right. Now, leading up to here, right here, you can see May 25th, 27th. All right, it was the end of May through or very early June. You've got this stair-stepping pattern going up. I got to get rid of some of these things here. Just tell it not to label them. That'd be great. All right, anyway. There's the intraday low, the red there, stepping up, and starting here June 8th, lower, lower. Today, so far the intraday low is a little higher. It's not like I don't have any faith you think can go higher, but I don't think it's as certain as some would like you to believe. Anyway, I'm still rooting for it, but man, look at that. We're on new intraday lows now. I don't know what's the deal with the volume either. Like, look at yesterday's volume compared with today. Then it ends up adjusting. So NinjaTrader's volume is screwed up. Ignore the volume. I don't think it's correct. These are 15-minute candles. All right. Anyway, I'll switch back to the other thing.
Trades also have the potential to increase execution costs for institutional orders such as mutual funds. In a presentation that I made to the IAC 2 years ago, I highlighted the impact of rebate pricing tiers using large numbers of alternative tiers and somewhat customized pricing within our system of fees and rebates. This clearly seemed designed to price discriminate under reasonable assumptions about the form of exchange costs, i.e. that the costs depend upon total activity, but do not depend upon the distribution across broker-dealers. The price tiering is significant in terms of best execution because it encourages small brokers to use larger ones for trading to obtain better rebates, arguably inconsistent with the requirements of the Exchange Act with respect to placing an undue burden on competition. Indeed, citing that problem specifically and my related academic paper, 3 congressmen wrote to the commission early last year suggesting a ban on pricing tiers. The case for such a ban is even stronger than at the time of my presentation or the subsequent letter, as the District of Columbia Circuit later overturned the SEC's efforts to study and potentially ban rebates after a market pilot. Of course, if the SEC had banned rebates, then the tiering issue would have been moot. Another key feature of current practice is that the pricing tier achieved by broker-dealers and others routing orders is only determined at the end of the month and is not transparent to asset managers, in contrast to the tiering based upon predetermined pricing, for example, in airline frequent flyer programs. In that spirit, and in the aftermath of my earlier presentation, the IAC itself called upon the Commission to require much stronger disclosure. But, as you've heard this morning, that has not progressed. This actually was a much weaker recommendation, I should point out, than those of the three congressmen. The unknown nature of the rebate rate leads to an agency conflict, even for institutional investors, and amplifies the agency conflict in order routing relative to the basic make-take structure. I would re-emphasize the earlier recommendations to the Commission, both the congressmen's and the IAC's. In my view, it should seriously consider banning price tiers for rebates, and absent that, should implement much stronger disclosure requirements. This is an important issue in a best execution context. Another important aspect of best execution is to what extent different market participants need to have access to various proprietary data sets in order to fulfill their best execution requirements, or should the access to data simply reflect the commercial preferences of various broker-dealers and asset managers? To the extent that particular data are required universally, is there any advantage to not including it in the SIP? The issue of data that would be required for best execution is complex, in part because of the market power of many of the providers of unique data, the range of proprietary data sets offered, the diverse business models for various intermediaries, as well as the locations of the various exchange data centers and trade reporting facilities. Data are not uniformly available at all locations due to latency and the geographic structure of data availability. Yet much of the SEC's regulatory framework, such as the meaning of NBBO, the import of the trade-through rule, and the underlying meaning of best execution, appear to largely abstract from latency frictions and the geographic structure of trading. The diverse geographic points at which prices are measured and the latency to identify and access liquidity are fundamental. Even with faster technology and of course assumed continuation of Moore's law, the geographic structure of trading and the physical constraint associated with the speed of light suggest that frictions cannot disappear in the limit. Given that, and the importance of relative time in trading, latency is inherent. It's not going away simply because markets are getting faster, and an important issue to address in the context of best execution. With collaborators, I have been recently examining post-trade transparency and the pattern of trading around the publication of trades. Our research highlights the difference in latency between off-exchange and exchange trading. We identify bursts of trading activity consistent with market participants learning about off-exchange trades from SIP broadcasts, but appearing to learn about on-exchange trades from faster proprietary feed broadcasts. The much lower response to off-exchange trading reflects greater post-trade opacity and latencies in reporting, and also the manner in which market participants utilize data. This highlights fundamental questions about the meaning of best execution in the presence of various latencies, including those associated with exchange versus off-exchange trading. For example, what are the best execution responsibilities of various market participants in light of their potential knowledge of trading activity given the latencies? To conclude, the underpinnings of best execution, both conceptually, as highlighted by my remarks, and pragmatically from the perspective of the goals of the Commission, require further attention.
Thank you so much, Chester. And we will give the last word to Dan Gray from the Division of Trading and Markets. Go ahead, Dan. We look forward to your thoughts, and thank you for making the time to join us today.
Good morning, everyone, and thank you to the committee for the invitation to participate in this very excellent panel, as you've just heard. I have to start with the mandatory SEC disclaimer that the views you're about to hear are my own and do not necessarily reflect those of the Commission or my colleagues on the SEC staff. For my opening statement, I thought it might be helpful to just highlight 3 SEC developments over the last year that affect best execution. The first, I think you've already heard Chair Gensler and Commissioner Peirce refer to a few times, and that was in December 2020, the Commission adopted rules that would overhaul the market data infrastructure for NMS stocks. One of the primary goals of those rules, when they're implemented, will be to expand the content in NMS market data. 3 ways worth mentioning. One, for round lot sizes, which are the quotes that determine the NBBO, for stocks with prices over $250, it would reduce the round lot size from the current 100 shares. Second, for odd lot quotes, quotes with sizes less than round lots, they won't be included in the NBBO, but they will now be included in NMS market data when they're priced in between or better than the NBBO, the National Best Bid and Offer. And then third, for quotes that are outside the NBBO, but by 5 price levels, they now also, when implemented, will be included in NMS market data. Now, the Commission in the adopting release said that the new rules are not going to change the duty of best execution, but that brokers should consider the availability of these new data elements in NMS market data when they're developing their best execution procedures. So in terms of implementation, just 2 days ago was the effective date for the new rules, and the next big step has to happen in 150 days, and that is when the NMS market data plans will be required to file amendments to the plans that should conform them to the new rules. And one of the key elements of this, the filing, will be proposed fees for the new market data products. Second SEC development of the last year I want to mention also occurred in December, and that was a settled enforcement order with Robinhood Financial. And included in that order was a violation of a broker's duty of best execution. The time period covered in the order was from September 2016 through June 2019. And one aspect of the order was a trade-off between payment for order flow for the broker and improved prices for the broker's customers. And in particular, the order outlines that the broker had sought from the trading venues to which it routed orders increased rates of payment for order flow. And in response, the trading venues had informed the broker that there's a trade-off, that if you want more payment for order flow, then there will be less money available to provide improved prices for the customers. And the broker explicitly negotiated to receive more payment for order flow at the expense of prices for the customer. And the order also outlined that subsequently the broker's internal analysis showed that there was a cost to customers, and in particular for orders, for example, for orders that with sizes over 100 shares, customers would have been better off paying a $5 commission than receiving the inferior price for their orders. The final SEC development took place in the first quarter of last year and has continued through the year up into first quarter of this year, and that is much expanded disclosure requirements for broker routing practices under Rule 606 of Regulation NMS. One of the things that became available last year in response to rules that the Commission adopted in 2018 was more detailed disclosure of where orders, different types of orders are routed, as well as for the first time a disclosure of the aggregate dollar amount of payment for order flow that brokers receive from the trading venues to which they route orders. I think the expanded reports have provided a lot of useful data. With respect, for example, to payment for order flow, they reveal a range of broker practices. Some brokers do not accept payment for order flow, and for those brokers that do accept it, there's quite a range of rates of payment for order flow that they receive. In total, in the first quarter of this year, 2021, the total payments for order flow received by brokers exceeded $1 billion. So I think the reports are useful. They're actually very easy to see and readable. They're online, and the easiest way to find one is if you're interested in a broker, you can just put in a search engine, Rule 606 report, and the name of the broker, and it will pop up. And so I would encourage anyone interested to do that. So those are the three developments I wanted to highlight, and I will be happy to answer any questions. Thank you.
Well, thank you so much, Dan, and we're lucky for your expertise. I see that it seems like the commissioners have all are no longer with us, but I just want to take a moment, just in case, to give them a chance to weigh in if they'd like to. And though they're often not able to join us, I do know that they all watch the proceedings very closely and are informed by the proceedings, so we appreciate that very much. So unless they want to weigh in at this time, and I'll just wait one more second here. If you're sure. Going once, going twice, and then if the commissioners jump in later on, please feel free to jump in anytime and let me know or hit me up in the chat. All right. Well, we got the queue right now is Mina and then Paul. So Mina, go ahead.
Great. Thank you so much. Well, I want to thank you all the panelists for taking the time to be with us today. This topic is one, as Paul Atkins mentioned, something that we've been talking about for decades in market structure, and so is one that is complex and touches the entire market structure. When you touch one area, it's almost like, whack-a-mole. Other issues come up. So I realize that you're threading a very careful needle here. So thank you for doing that. I have two questions. One is for Sal. Sal, I was wondering if you can help us understand your thinking about PFOF and then moving on to exchanges. In my mind, I've always thought of PFOF as a separate incentive structure. I understand they're interrelated, but I view them as a separate incentive structure, one that I would think wholesalers would be generally agreeable or indifferent to because in getting rid of, because it's a fee they have to pay and nobody likes to pay extra fees unnecessarily. But that's one issue. And the second issue appears to be moving retail trading onto lit exchanges. And I'm curious how you think about those two separate issues, or are they so commingled that you can't separate them?
Well, thank you for the question, Mina. And again, I apologize. I'm hoping you can hear me because I'm using my phone for the audio.
We can hear you.
Perfect. So I think one of the problems with our regulatory structure is there are different rules of the road for off-exchange and exchange. And because of that regulatory disparity, you'll see order flow migrate in different ways. Often that benefits the broker's bottom line as opposed to what might be best for clients. So banning payment for order flow in the dark, for example, Robinhood cannot accept payment for order flow, and Virtu and Citadel cannot pay it to TD Ameritrade or Robinhood.
Just so everybody knows, the ticker on the top here is delayed by, I think, 15 minutes, so don't pay any attention to that. That's just part of my Reuters icon thing.
It's going to lead to unintended consequences. When we craft rules that are very, very, very specific, I get very scared that they're, going to be changed and altered and lobbied and mashed up so that by the time it gets to market, there are so many loopholes in very specific rules written that it tends to be unusable for the market, whereas simple principle-based regulation serves best. If you remove the maker-taker system on the stock exchanges and it were to be replaced with flat fees, then I don't even mind if Virtu has a lower flat fee than I do. I mean, Hertz can buy a new car cheaper than I can buy a new car. I don't even mind that. But removing that distortion, that maker-taker pricing system, would reduce so many distortions in order routing. And doing it on the exchanges and doing it in the dark will have the best impact on making our markets more robust, and especially it will bring retail order flow back to the lit markets, which is where we want. I think the SEC should really be concerned that the displayed market and the marketplace doesn't represent, it represents, less than half of the order flow that's taking place. The people who are trading, referencing that order flow, are the same people who are making those markets on the lit markets. So that's kind of weird in itself. And I think they should be concerned and trying to incentivize diverse participation on the lit exchanges. Retail investors, institutional investors, prop traders, you name it, everybody. If we do that, you're going to see deeper quotes, you're going to see narrower spreads, and it's not only going to be great trading McDonald's on a boring summer day, it's going to be great trading mid-caps and wider spread stocks in times of stress. And that's what I would recommend, and thank you for the question, Rena.
Great. And I just want to jump to a question for Tyler. Tyler, I suspect you want to opine on that question, but I'll just pose another one. You had mentioned the proliferation of retail trading. And so I was curious if you could speak to the role of zero commissions and if that facilitated more trading. How do you think about the trade-offs between democratizing trading with the volatility that you noted that could be bad for markets and bad for retail as well? That's the first thing. And then also you touched on best X considerations for investment advisors that the SEC could provide more guidance on that. Could you speak to that as well? I'm not sure, Tyler, if you're trying to come on, but we can't hear you.
My first one of those in a full year. Anyway, so thank you all very much. I really appreciate it. I'll start with the retail question first, and then I'll move on to the investment advisor question. But on the retail side of things, look, any economist will tell you when you make something free, it'll get consumed, and it might even get overconsumed. And one of the things we've done is sort of, from an optics perspective, made this look frictionless. As I mentioned before, my teenage babysitter at a traffic light trading AMC call options, which, by the way, she does, and that's somewhat terrifying. But as we made it so easy, one of the things we also have to realize is we've added some risks to it. So has she read the 188-page options disclosure document? Does she understand what that means? Does she understand the risks associated with options trading or those types of things? And the answer is obviously no. But the other question is, so we've said this advertisement of free trading, and we all know it isn't free. Right? At the end of the day, we know there's something. Now, what we used to hear, and we don't hear as loudly anymore, is we used to hear this argument, particularly on the retail side, that, hey, this is free. It used to be $10. You get rid of payment for order flow, and it's going to be $10 commissions again. And my response to that is really simple. If we're talking about a single share trade, what's the payment for order flow associated with that trade? Why is it that trade would all of a sudden become a $10 trade? Right? Like, how is it these two things, the dollars and cents don't really line up, right? Like, if we're thinking about what the size of the payment for order flow is today, that's theoretically being used to offset what would otherwise be an explicit commission, they don't line up. There isn't any relationship. So if we look at, broker dealers, and particularly retail broker dealers, what we see is they make money on net interest margin, and they make money on, frankly, margin lending. Something that obviously some of them have to be a little bit sensitive to in times of these extreme volatility. And so when we look at the other revenue streams that retail brokers say, we're not talking about those. I don't quite understand the math of how you would say, hey, here we're going to give you 1/10 of a penny a share, or 2/10 of a penny, or 3/10 of a penny, maybe even as boldly as we could be, in payment for order flow on one hand. And the response is, if we eliminate that, you now all of a sudden have to be charged $10 per trade. I don't see how those two necessarily line up. But I do think we have to recognize that what it means is we are going to see, because of this system, a lot more of very small trades that are very risky by a large number of market participants. The incentives for your brokers and the market makers is smaller dollar trades, more of them, stocks with wider spreads or options. Like that's what they get paid more. That's what they're going to want to see. And that's what we are seeing in the retail boom. So that's something we have to recognize. And the impacts of that means we are going to see a lot more volatility. And again, we have to recognize how we address that. On the investment advisor side, and I so appreciate this, we spend a ton of time arguing about broker dealers, best execution obligations, and frankly today, and rightly so. I have members that have done studies with particular broker dealers when they're doing their transaction cost analysis, and they find that some brokers are almost always executing at trades that look like trade throughs when you look at the proprietary data feeds, but don't look like trade throughs if you look at the SIP. Right? Huge percentages of their orders. And you go, wow, are they really getting best execution? So we have seen those types of things. And obviously, Bobby Bartlett, a professor at UC Berkeley, just came out with a paper saying in the retail space, hey, there are a lot of retail customer trade seems to be at trade throughs when you look at the proprietary data feeds. So those types of things happen. But investment advisors, there's no rule. You know, we have with FINRA, there's rules, there's guidance, there's enforcement cases. Dan just mentioned Robinhood case from December, but there really isn't a single rule about what best execution means for investment advisors. So do they have to have policies and procedures? If so, what do those policies and procedures say substantively? What reviews do they have to conduct? A couple of years ago, the SEC's Office of Compliance and Examinations, now the Division of Examinations, did a review, and it basically said, hey, we found these deficiencies in investment advisors' best execution obligations. And my response is, how are they deficient? Right? How do we even know? We know best practices. We know that the investment advisors and pension funds that really care about this stuff have robust policies and procedures. We know they're doing monthly meetings of best execution quality and changing their brokers and their routing strategies based on those things. We know that they're evaluating the costs for investment research. It's not just about trading costs, right? Trading costs can also include research payment costs. We know that they're valuing those services, the execution and the research. But frankly, there's nothing from the SEC other than, again, an OCIE risk alert and the occasional mutual fund share class enforcement case to really say that. So from my perspective, we have two things that the commission really needs to do. One, they need to enforce with FINRA best execution as it currently exists in the FINRA rules, which I think would eliminate a lot of the problems we have now. Not rule changes. We obviously should be changing some rules, but that. And two, actually creating an understanding of expectation of what it means for investment advisors. Thank you so much.
Sorry, Tyler, just one last thing. It's not in the fiduciary rule either, right? You would think that that's where it shows up in terms of investment advisory guidelines.
Correct. So when the commission actually just revised its fiduciary obligations and interpretations and guidance respected to that, it's one paragraph. Right? And it just says you have a duty. And I appreciate them saying to investment advisors, we know you have this duty of best execution. And I also appreciate that the commission has occasionally brought an enforcement case. And I appreciate that they've got the Office of Compliance and now Division of Examinations looking at best execution by investment advisors. But there's no rule. So we're probably not going to see any detailed cases saying like, hey, you haven't even bothered to look. So we're really at ground zero when it comes to investment advisors. And that's something I think both from an execution quality, trading prices, but something this committee I know has also looked at is research. You know, should investment advisors be valuing the cost of research, and when they pass that through to their customers as part of a trading commission, are they doing that as well? Thank you.
All right. If anybody else from the panel is really eager to jump into that, I don't want to stop you from offering a quick observation. Okay, I have Paul, then Jennifer, then Brian, and then I'd like to put myself in the queue, and then the queue continues to grow as folks want to jump in. So, Paul, go ahead.
Great. Thank you all so much for these comments, which I found very enlightening. And this is a question really for anyone on the panel. Every comment at some point touched on the incredible proliferation of trading venues and types of trading venues. And I guess just as a very basic question of first principle, is the market too fragmented, and what can the SEC do about it, and what should it do about it?
If you don't mind, I'd like to jump in and answer Mr. Mahoney's question, and I appreciate it. It's a great question. I believe the markets are very much too fragmented. There's 16 exchanges. There's 40 dark pools. Now there's dealer platforms in the mix. And where to go is not only complex, it's governed by cost, and it's also governed by incentives. But let's not exempt the exchanges from this. There are 16 stock exchanges. If you look at the big three, they each operate several exchanges, including what we call in the business inverted exchanges. Some have a maker-taker structure of X. Some have a taker-maker structure of Y. And all of these different structures are designed for two reasons. A, to, in a sneaky way, segment order flow on the exchanges, because they know that institutions, if they're doing their best, if I'm trying to get my client the best price, rather than be in a long line to buy McDonald's at the back of the queue on NYSE, if I were to bid on a much more narrow quote like IEX, which is flat fee, or an inverted exchange like YBAT, I would be closer up to the queue and more likely to achieve a passive fill, but I'm also giving up that I care about that. So I'm an institutional broker representing an institutional manager who's trying to get a better price, which maybe makes me look different than a Robinhood trader. I'm not sure. But all of these systems are designed to, A, segment order flow, and B, the exchanges don't really make too much money from transacting. They rebate some people, they charge other people. The net 5 mils, 6 mils, 7 mils, 10 mils they make on trading is not what really flows to their public financial statements. What they're really selling is speed and access and co-location and data feeds. These tools are very, very useful if you're trying to win a race between destinations. And the more destinations there are, the more need for that speed. So the exchanges know very well what they're doing. The fragmentation is there because of this complex payment for order flow maker-taker system on the exchanges. It's good for the exchanges. It's not good for investors.
I'll just make one observation. Thank you. Agreeing very much with Sal, and I just point out, for example, you wouldn't have so many exchanges with essentially the same business model in a normal world. So I think one of the things we have to appreciate is if your pricing structures are remarkably similar and your sort of services and customers are generally the similar, then you would normally think, and what would make the most sense was to have these exchanges sort of consolidate. You would think just consolidate operations and have one exchange or two exchanges owned by the same parent or family or family. And so we don't see that. And just going back to Sal's point, the idea is because the market data has the value, and the difference, there's an added value for some of those market participants and for the exchanges of having two places rather than one to trade.
Well, and just to jump in as well, I mean, I think, if we look at the incentive structure that's being discussed, but also at, Reg NMS itself, just to go back to my favorite theme here and Rule 611, it encourages the atomization because the biggest stock in trade basically in the markets is information. And the way to ferret that out is through testing and all the, gamesmanship that I referred to earlier. And, it's basically countenanced and encouraged by that top of book protection. So you get what you have. The SEC, got what it wanted in many ways, but the unintended consequences are not exactly what I think we all would like.
So if I can also jump in, so I'm generally in agreement with the comments of my fellow panelists on this issue. I think Paul's raising a very important question. I think in part the extent of the number of exchanges and platforms is partially a consequence of the structure of commission rulemaking. Right, as in many other contexts, sometimes the structure of regulation changes the way in which markets are organized. One observation that I didn't focus on explicitly today, but I have made in some of my other writing, is that NMS actually directly leads to proliferation in one important respect. NMS provides protection not all the way down the book, and this is not to advocate that, by the way, but NMS provides protection only at the top of the book. Now, so if you have an exchange that's providing protection, and order protection is a benefit. Now, if you only are being protected at the top of the book by proliferating exchanges that would get protection, potentially there's a direct regulatory incentive to operate more exchanges. In a different guise, when I've chatted with exchanges about some aspects of this, they point out, well, if they want to operate different types of platforms with slightly different business models, they have to do it under the guise of different exchanges. For example, you can't operate a make-take and a take-make under the same exchange. So I think, with respect to the extent that this is an important issue, I think the Commission needs to look at its structure of rulemaking, as compared to kind of a simple, it seems to me like the natural alternative might be a very simple structure, which simply lays out, some broad principles and basic responsibilities, including best execution.
All right, terrific discussion on that question. And next, our chair, Marietta Westbrook. Go ahead.
Thanks, JW. So my question is directed to Paul and Chester, but I really welcome any comments. So, Paul, you had mentioned the Commission engaging in a comprehensive review. And so I wanted to know if you envisioned that would be solely studies before any rulemaking, or whether you think those two things go hand in hand. We all know this can take a while to do studies and then follow that with rulemaking. And then, Chester, the related question there, if the Commission needs to acquire more information, do they have access to that information? Is there data that is not available to them that would be important before they move ahead?
Well, thanks very much, Jennifer. I was basically, so here's I dug this out of the files here. It's the Market 2000 examination of current equity market developments. In many ways, it kind of set the stage for what later happened in the mid and late 90s with the technological innovations and everything else. But a lot of things that it talked about, it kind of got overshadowed by a lot of those developments, the 9/11 and whatever, and then finally NMS came along in the mid 2000s. So, but if you look at what the Commission has done historically in other ways, like what we call the Red Book for investment management, also done under, when I was working for Chairman Breeden in the early 90s. That did set the stage really for a lot of the innovations in the investment management and collective investment area. So that, and then what Congress did later on in the mid 90s as well with NISME and whatnot. So I think all of these things the Commission, has with these studies that it does, where it kind of takes a look in a comprehensive, holistic way of what's going on in the marketplace, solicits comments, and then comes up with, albeit a tome of how many ever 100 pages here. I think it's really a good way to then refer later on to what the staff has put together. It's a lot of work, but I think it really yields a lot of benefits ultimately, and engenders a lot of discussion and innovation later on.
So Jennifer, I very much appreciate the question that you directed to me about to what extent can there be enhancements to data, and how would that be helpful? So let me try to respond to that at a few different levels. So first, I do think that the Commission itself potentially, and within the context of various legal constraints, can do a much better job in facilitating access to market structure data by the academic community. I think actually the Commission has done a pretty poor job in this regard. It kind of considers a lot of this data. It just wants to, it says, well, we have a staff that can analyze it, but the staff resources in the market structure area that can analyze data are a handful of people. There's an academic community with a lot of talent and a lot of sophistication. Now, and I think that community is doing interesting analyses, but the Commission certainly has access to much better data, and I don't think has done a particularly good job of welcoming or encouraging that access. And I'm not talking about access to personally identifiable information. I understand that's obviously an important constraint. That's not really what the issue is in my mind. More specifically, I was disappointed by the Circuit Court ruling on the fees and rebate on the fees and rebates pilot on the pilot, but I think at the same time, I think potentially the Commission would have either might have enough information to proceed on that issue, or if not, needs to kind of make the case much more persuasively. Frankly, I was not so impressed with the arguments that the Commission brought forth to the Circuit Court, where it basically kind of almost said it was clueless about the fees and rebates issue and what would happen. Well, the Circuit Court says, well, you can't just do a fishing expedition. The Exchange Act doesn't give you a license to experiment. So I thought the Commission could have done a much better job on that issue. And frankly, I was surprised that the prior Commission just then kind of folded its tent on the issue because there was uniform support. The pilot was a 5-0 decision. And let me turn to one more specific point on the issue. I think a considerable improvement. I actually think that the agency problem is made considerably more severe by the tiering of rebates, and this was a theme both of my presentation today, but also my presentation to the committee two years ago. And I think on that front, the academics don't have relevant information. We have no way to ascertain to what extent there are these differences in pricing across the different participants. We do observe, of course, that there are huge numbers of pricing tiers that are out there, so we presume that there must be significant differences. But it seems to me the Commission, in principle, probably has access to that information. But I don't see any effort, but I don't see the Commission having the resources to study that. Whereas I do think, this relates to my broader point, that the academic community potentially would have the resources to study that issue if the data were being made available. And I think part of the problem is a transparency problem that I think the Commission could alleviate in this space.
Yeah, if I could just add to everything Chester just said, which I think is extremely on point. It's disappointing to me that we rely on a private market participant study to say we as an engaged capital markets broker dealer say that there are these X thousands of pricing tiers, which largely seem to be customized, right, by the exchanges. Now, we have an Exchange Act that says things have to be non-discriminatory and they can't be undue burdens on competition, and they have to be fair and reasonably and equitably allocated and all of those things. And yet we have customized pricing tiers and that numbering in the thousands. It seems somewhat inconsistent, but as Chester points, there are very direct competitive effects. It's not lost on me that the number of exchange members has declined significantly as these pricing tiers have exploded significantly. So the Commission could add a lot of transparency there and ideally take actions with respect to addressing those things. Two, I'll note that The commission did require enhanced 606 disclosures. Unfortunately, for large institutional investors, they still may not be getting information about how their orders are routed from start to execution. And what that means is that's not useful for their TCA. To the extent that some large institutions, including some of our members, have been able to get that through the compliance with their brokers and frankly, lots of negotiations and their own market power, they have found and identified brokers that were performing very, very poorly and some that are performing very, very well. And so the commission, again, should have to revisit 605 and 606 to provide, frankly, market participants the information they need to make those informed decisions.
All right, thank you. And just to take moderator's privilege quickly to note, to your last point, Tyler, we adopted a unanimous recommendation that the SEC provide more disclosure about rebate tiers on the basis of your comments, Chester's comments 2 years ago. And we remain hopeful that the Commission will give that serious consideration. And it's something that I would highlight for all the commissioners and staff to give some thought to. And to the point about research and data, you know, I will say, I think you and a couple of folks have referenced the great Bartlett paper about odd lot issues in odd lot execution. That's a terrific paper, and it's one that comes on the heels of another paper he wrote that was skeptical of latency arb, frankly. So he's very much an objective academic. I think he's a great resource, and generally speaking, I think it is very helpful when we see commission studies and academic studies where the data is accessible and challengeable. What's sometimes difficult is when we get industry studies, but we don't get to see the data, and that's not really fair in empirical finance, right? It's not fair play. So, you know, I'm hopeful for more of that transparency in data work. Okay, with that editorializing aside, Brian Helmer, you're next up.
Thank you. This is a question to anyone on the panel that wants to weigh in. During the course of the comments, we heard reference to at least some of the panelists just make comments that the definition of best execution is suboptimal and potentially needs to be adjusted to have the rules be more effective. You know, that's a debate that's been going on for my entire career, that definition of best execution. So the question is that a productive focus point to try to revise for the Xth time that definition, or should the commission would it be better to focus more on eliminating conflicts of interest and improving transparency as a very straightforward way of addressing these issues versus mixing this very complex question of best execution into the conversation?
So maybe I can kind of start a response to that. So you know, I think both directions are relevant. Obviously, you know, conflicts of interest are important, and in parts of the best execution issues and some of the effects associated with the tiering of rebates or the generic issue of rebates, conflicts of interest may well be important. You know, that's obviously an issue to be, for final judgment to be made on. But I do think, I think on the issue of definition, the reason in part I raised it, well, on the one hand, I actually think that a lack of clear definition has a real advantage. What's the advantage? It allows things to kind of evolve organically. As technology changes, the commission can evolve its view. So, for example, as things get faster, as the nature of the data changes, the commission can kind of naturally evolve its view. That's the pro side of it. But on the other hand, it does lead to kind of a fair amount of lack of clarity about what are the responsibilities of the parties. And I would highlight there one specific point. A lot of this discussion is sort of framed around a world in which there is no issue of latency. And to the extent that latency issues are important, it seems to me that one does need to do some sort of review of what best execution is supposed to mean, because I don't think I'm not persuaded that it's well defined in a world with latency. But perhaps it is. But
JW,
I don't know.
I'd like to just quickly weigh in on the topic of legislating best execution. As I hope I outlined in my opening statement, it is so complex. And to think that, and I mean this with the greatest respect, but to think that the commission and committees are going to be able to understand latencies in between different destinations and the changing nature and rule changes of what's happening in dark pool 1 and dark pool 2, and be able to mandate a specific course of action for a broker-dealer just doesn't seem to be very logical to me. So I don't think it's a good idea to be legislating best execution. And as well, latency does not define best execution either. If I try to compete on speed with Citadel, Virtu, the largest, most technologically spending banks, and I try to compete on their terms in a race around the dark from destination to destination, and that's going to be the measure of my success, I'm going to lose, and I'm not going to have a good execution. But if I instead try to think outside the box and figure out ways to have myself interact with liquidity more naturally and have liquidity find its way to me, then I've added something of value to my clients. And I think a rule legislating a specific aspect of best ex or speed is not going to capture that. Thank you.
Yeah. This is Ty. I just want to sort of pick up on a few things. I'll note best execution is only valuable if it can be enforceable, and it's either going to be enforceable by regulators or it's going to be enforceable by the investors who are being impacted, right? Those are the parties who care. And I'll start with you, Brian, right? As a pension fund person. Right. As we think about these things, it's not just what best execution is for the retail investor, which is what we're going to hear a lot about in the next panel, but it's also what's best execution for you, and your needs are somewhat different. But the overall objective is frankly the same. It's trying to get the best prices that you can for the overall amount that you're trying to trade. And it's a fiduciary obligation. And so one of the things I think we have to recognize is, frankly, a senior official at FINRA, who was once a senior official at the SEC, has candidly said over and over and over again, when those of us have come to him and pleaded, hey, you need to be bringing more best execution cases because we are seeing our broker dealers do X, Y, and Z. And he says, look, bringing a best execution case is like trying to nail Jell-O to a wall. There's so many factors that people can consider. We're going to say, hey, there's so many things, and it's about right. So I think what regulators can't do is say this particular price is exactly the right price, or you have to be the fastest. That's where the order protection rule, I start to get sympathetic with those who have concerns with it. But I also recognize it's a backstop. It's a backstop on best execution for investors. So you can't just eliminate it. But I do think we have to focus on where we can. Where the commission is good at doing is saying you have to look at stuff. You have to have policies and procedures and practices. Going back to, there ought to be something for investment advisors, but for broker dealers, again, it's policies, procedures, practices. What are you doing? Are you really doing the things you're supposed to be? And I will note, again, a lot of the concerns we've seen and our members have seen is, quite frankly, brokers not looking to all the venues that they should be looking at, not considering dark venues, not considering lit venues. And so those types of things. Are they preferencing, for example, their own affiliated ATS? FINRA just did a study a couple of years ago, basically saying, hey, brokers that tend to route to their own affiliated ATS more tend to be correspond with lower fill rates and worse execution quality. So those are the types of things we need brokers focusing on. Are they appropriately looking at all of the potential execution venues? So that's where I would focus the commission, is on policies, procedures, practices, and those types of things, and directly eliminating conflicts of interest that can stand in the way.
Yeah, to throw something else in here, if I just a few seconds, the best execution, you're right, is it's basically should be a principles-based type of thing because of all the factors that are involved, and I think it's really hard to have a precise definition, and because basically the concept grows out of agency law, and a broker most often is acting as an agent for the person who wants to do a trade. And so if you're a big institution and care about the pennies and sub pennies that perhaps is being left on the table or not going to your account versus the long-term retail investor for whom he shouldn't necessarily be concerned about all of that, because he should be concerned more about saving and investing for the future, as long as he has protection through the various organs and avenues of the government and elsewhere to make sure that his agent is doing what he's supposed to and trying to achieve the best efforts through his best efforts, the best execution, however you define that. So that's necessarily squishy, unfortunately, but I think the problem that we have right now, as I mentioned earlier, is that NMS, by focusing above all on price, is what we're getting now with the the atomization of the marketplace, all the different gamesmanship that goes on, and so ultimately, all of that is coming into the package that we ultimately have.
Well, I don't know about y'all, but I'm having a lot of fun with today's discussion, and I'm learning a tremendous amount. I'm putting myself in the queue to jump in with a quick question, with two questions. First, I want to just, out of respect for Commissioner Roisman, he wasn't able to join us, but he provided an opening statement. And one of the things he mentioned in Commissioner Roisman's opening statement was that there's insufficient disclosure about any terms of payment, inducements for order flow. And he suggested enhanced disclosure about that issue. It seemed to be an issue where I think our panelists might be in some agreement, and so I wanted to throw that out there to see how Commissioner Roisman's suggestion could be helpful and how it could be implemented. Ty, you're on mute.
Yeah, it's somewhat actually impossible today in a useful way on the institutional side, particularly with exchange rebates. And the reason why I say that is because when a broker makes an order routing decision on an institutional side today, they do not have certainty with respect to the fee or rebate that they will be assessed on that order. That's because the way it's set up, the volume weighting tiers, and I'm going to steal liberally from Chester's work, but the volume tiers are sort of in the month you're in. So if you trade on, let's just say, June 8th, you may not know until June 30th what the fee or rebate you get is. So it doesn't then, let's just say for a minute, you want to share that information with your customer. It doesn't come through on the trade confirm. So this creates a couple of challenges. One, the customer is not going to ever really want you to do pass-through pricing. So a customer today, you might say, "Hey, let's just get rid of the conflict of interest. I'm an investor. I don't want my broker to have this conflict. So I'll do sort of cost plus pricing." It's hard to implement if you're an investor that has a mutual fund where people can come and go every day, because you don't know the fee or the rebate that you're going to be assessed for days or weeks later. The system is so complex that CBOE was mischarging people for years and nobody figured it out. So I think if we want to straighten up that system, if you want to add true transparency on fees and rebates, I would argue absolutely yes on those incentives. But you have to do it at the time the trading decision is made. And that would empower institutional investors and others to actually negotiate. Maybe they want to eliminate this conflict of interest with their broker. But what that would require, first and foremost, is revising how the fees and rebates, how exchange pricing tiers go into effect. So they would have to be prospective only. So if you were to let them still be volume based, they would have to be January's volume determines the fees in February. Yeah, and that would actually fundamentally change the ability, and the transparency of that would allow investors to make decisions. But if you just do it after the fact, so at the end of the month, you would give a large institutional investor, hey, here's what our fees and rebates were for your trading. That's not decision useful information. So that transparency would be useless.
Can I say something that's going to sound, I'm just going to go out and say it. I hope you've all seen the movie Moneyball. And there's a scene where Billy Beane is sitting around the table with all of his coaches who are talking about the same old issues, the same old ways of looking at things for years and years and years. And he just starts saying blah, 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 and all of his scouts around him lambaste him and can't believe it. And he says, and he chastises them and says, we're looking at the wrong things. Whenever we legislate these specific things, we're going to inevitably be looking at the wrong thing. I can guarantee you that any of the institutions that are trading through me are not looking at, Sal, I want to know what on this part of the child order that you routed here, what was your incentive? Did you pay or did you make? Did you take? Okay. They want to know that they're trading with someone they trust, who's cost agnostic, who's looking to get the best price wherever it is. That's what they care about. They don't have the ability to measure all of this blah, 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 and they don't want to. So that's why we need to be taking these conflicts and complexities out of the marketplace, because they're making everyone's lives a mess, and they're stopping us from going and reforming markets. Because every time we have to have a holistic look at data, and we have to have a holistic study, and we have to look at everything brand new, and that just is code word for stall. Anyway, thank you.
All right. I think, Ty, you wanted to mention something else in relation to that question?
Oh, no, I wanted to echo. I 100% agree. At the end of the day, having more transparency on a conflicted system, look, it's far inferior to just having a less conflicted system.
Yeah. So did anybody else want to jump in on that question or speak to Commissioner Roisman's point?
Well, I would agree. I would agree. I would agree as well. We should want to try to move to a much less conflicted system. That seems to me kind of fun. That seems to me fundamental. At the same time, I think one needs to recognize that there are various forces and market participants who actually prefer a conflicted system.
Yeah. So I want to ask one last question, just a second, and make sure that we keep time for Ted, who's waiting for. I think Ted's going to have the last word today. So one last quick question: building toward compromise and the inevitable, difficult back and forth of sausage making as the commission gets to a full rule and hopefully a unanimous rule, right? Is there room? Is there a negotiation window here for some discussions about trade through? The enduring distortions from trade-through rule and unpredictable consequences of the trade-through rule, and about the conflicts of interest that rebates pose. Is there some way to match those two together for the commissioners to have a kind of a bipartisan, unanimous discussion about both of those issues? I know Canada has, I'm not an expert in Canada's trade-through rule, but I know Canada has some version of this that's much less onerous than what we have. Can we look to that system as inspiration? I know Chair Gensler has been looking to appropriately to other countries for inspiration about how to approach rebates and the conflicts of interest that they pose. Can we look to Canada's version of trade through? Can we look to elimination of the two types of payment for order flow, exchange rebate, and PFOF from the wholesale internalizer, and maybe even on a basis of just those top most liquid stocks where the sort of liquidity arguments just don't hold. Is there a way to bring those two things together? Is there some half a loaf that the commissioners can hopefully come to a discussion to achieve? I know it's a big discussion and it's going to take months to do, but I just want to get some initial early thoughts before we move to Ted, if anybody has some ideas on that.
I'll just say, look, I leave it to the commissioners to figure that out, and you threw a lot out at us. But I would say OPR is a backstop, and at the end of the day, it creates problems, and we've talked about it. But it makes no sense that the burden is on an exchange to then route to a competitor right? Like I've never quite understood how we have a duty of best execution that falls on broker dealers and investment advisors, and now all of a sudden we're going to impose on exchanges an obligation to route orders to their competitors. And obviously those that do get routed tend not to be executed very well. So I think one challenge when we talk about, sort of eliminating OPR of the order protection rule or something else, is that it then relies on the expertise and capabilities of the investor to figure out how they can best protect themselves. That is going to favor the largest institutional investors. Frankly, it's going to favor some of my members who have invested millions and millions of dollars and hired outsourced people who can help them measure their execution quality. So when they get poor fills, they will actually be able to identify those things. The question then becomes everybody else in the marketplace. Are they going to be able to identify when they're getting poor execution quality? The broker is not living up to their best execution obligations. And I think you'd have to figure out what that new backstop would be to try to protect, frankly, everybody else. So I understand eliminating the conflict of interest in terms of order routing. Obviously, I think there's probably a lot of agreement there, or dramatically reducing it. But I do want to say when we get to OPR, just eliminating it without anything else, as long as there's enough data available, which doesn't exist right now, but a handful of most sophisticated market participants will be able to compel it, and they'll be able to protect themselves, and everybody else won't.
I would add, ask yourselves in other countries, well, I'm going to say this quick and let Mr. Atkins jump in because this is his expertise. There's a ban on payment for order flow in the EU, in Australia, and several other countries. And if you look at their spreads, their bid-ask and mid-caps, they're dramatically different than ours, and they're lower. And so maybe we shouldn't be asking the guys who like the spreads really wide and who make them on the exchanges and who fill them in the off exchange what they think about what we should be doing for market structure. We should be looking at some of our international neighbors because they seem to be doing a better job than we are.
Yeah, so let me thanks, Mr. Bain. Just to add here, I agree it's good to look at other countries. If you look like with respect to best execution, where the last question was, whether or not it should be principle based or, some sort of hard rule. If you look at what MiFID's done in the EU and Australia and others, they all recognize that it should be principles based, and they lay out the various factors, kind of like what's here. So I think that's instructive. With respect to other things, that's why I think, that there is really room for a step back at, with a concerted study of what's going on because of the danger of unintended consequences. Mina Nguyen earlier called it whack-a-mole. And so you may be able to, if you ban payment for order flow, I've been around long enough and been through enough of these debates through the 90s and 2000s and whatnot, that something else will crop up. I mean, it's just, I remember when I first came to the commission and asked Senator Graham, what he thought about market structure and how we got into it. He said, and, what the best approach is, he said, well, Paul, follow the money in his very good Texan drawl. And I think that's, the real issue here, that there is always ways. Payment for order flow, as people have said before, has powered zero commissions, by some market participants, which then reverberated throughout the market. If you ban that, what will happen there? What will retail investors who have gotten used to zero commissions, and as has been raised before, you don't get anything for free, but still, what are the ramifications potentially for that? So, NMS created a lot of unintended consequences through its rules, and I think, before the commission sort of goes higgledy-piggledy and tries to do various things, it really needs to step back and not to waste time, but to make sure that, things are laid out and it knows what the potential consequences are before it, hastily acts in one way or another.
All right, Ted, the floor is yours for the last question.
Okay, but thanks very much, JR. And I want to thank the panelists for sharing. It was just outstanding, very enlightening today. And my question, which I guess would be the last question, is, now, I'm sure you attend conferences, events, Zoom meetings, being presented by the players or people in the industry, broker-dealers. What are they saying about best execution, conflict of interest, the number of exchanges that we have. What are they? What is the feedback? What do you hear them saying in respect to those items?
Depends on your conference. If you're at ours, you're hearing the Healthy Markets Association. I think you'd hear, and we're going to do as ours later this fall. You're probably going to hear an awful lot of discussion of we need more information about how our orders are routed so we can make sure we can keep an eye on whether or not our brokers are fulfilling their best execution obligations. One of the major problems our members have, part of the reason why our trade association exists, is because they're deeply concerned with brokers, their agents, sort of taking payments and making routing decisions in ways that maximize their brokers' profits and maybe hurt their trade quality. And frankly, in the retail side, they're looking at, again, Doug Sifu's on the next panel here, but they're looking at that and they're saying, wait, this guy goes on television and says, we're agnostic as to whether or not a retail broker is keeping some of the money for themselves or none of the money for themselves and giving some of it to their customers. So they're admitting that the brokers that they're paying with their payment for order flow are choosing whether or not to give better prices to their customers or keep more for themselves. And so, our institutional customers are saying, hey, we're worried about that for us too. And so that's our conference. But I bet if you were to go to a broker-dealer conference that's, perhaps SIFMA or someplace else, I suspect you would hear a very different concern.
Mr. Daniels, I'd like to weigh in as well. I think what happens is when we legislate very specific things, you should achieve X, you should dot this I, you should cross this T, all right? Because the here, they have a need to quote unquote tick a box. Am I doing something that's not going to result in financial liability to my organization? And solving that and ticking the box is often not the same thing as getting best execution. In our business, we talk about something called the volume weighted average price, the VWAP trade. Did you beat the VWAP, the average, the rough approximate average of all trades weighted by volume throughout the day? If you're executing, did you beat the VWAP? And I can tell you that VWAP is certainly gained, and I can rig it so that I hate to say, never say the word rig on a government panel. Jesus Christ. I execute in a way so that I beat the VWAP, but I'm not getting my clients the best price. So that's the thing I'm concerned with when we start talking about very specific things in legislation. Thank you for your question.
Okay, thank you very much. Yeah.
Thanks, everybody. I appreciate a terrific panel. My goal today was to get the smartest minds in the room together on this issue and hear a technical discussion about issues that have been raised in the popular press but are never sufficiently addressed in the popular press or never in a thoughtful way. And that's exactly what we did. We got a thoughtful discussion with some depth that I think hopefully will be helpful to the Commission's deliberations on this issue. So thank you all so much for participating and joining. I really appreciate it, Chair Marietta Westberg. I think we're all set.
Thank you, JW, and thanks to all the panelists. I agree. This has been a really fantastic, in-depth discussion. With that, we will adjourn the morning session and we'll be back at 1 o'clock for more Best X and 10B51 plans. Thanks.
Thank you.
Thank you.
Order filled. Order filled. Order submitted. Order submitted. Order filled. Order submitted. Order filled. Order submitted. Order submitted.
Investor Advisory Committee meeting. Before we get started with our two afternoon panels, I want to recognize that Nancy Lamont joined us this morning, and also member Lori Lucas has joined us. So we're going to continue with best execution discussion on the first panel this afternoon, and then move to the 10B51 panel. I want to thank JW and Mina for their efforts in putting together this first panel this afternoon. With that, I'll turn it back to you, JW.
Thank you, Jennifer, and I want to thank all of our panelists. I want to thank Adam and Sinich for helping us put this together, and Rick from the Investor Advocates Office. I want to thank Mina for all her help. Every time I was in a crisis, Mina solved it in helping to put this together. So thank you all so much for that. And I will miss you terribly as a colleague, Mina, but we're going to get you back as a panelist in some way. So you think you get out, we'll always pull you back in. I want to introduce all of our panelists today. Let me start by introducing Stanislav Dolgopolov. He works at Decimus Capital Markets. He's taught securities regulation at UCLA, has co-authored a book with Chaim Bodik titled The Market Structure Crisis, Electronic Markets, High-Frequency Trading, and Dark Pools. And on a personal note, Henry Manny, the founder of my law school, once told me that he was a mentor to me, and he told me, I think ominously, that his most important mentee ever was Stan. So I took that as a hit and a good word for Stan. Larry Tabb, welcome, Larry. Larry's been in these discussions and is omnipresent in discussions about market structure. Larry serves as the Director of Market Structure Research at Bloomberg now, and previously was chair of the Tabb Group, where he was a convener for various panels and events about market structure and a frequent speaker on these topics. Welcome, Larry. We're glad to have your help in these issues. We welcome Hitesh Mittal, the founder and CEO of Best Execution Research and the former global head of trading at AQR. Hitesh, just like Stan, has a recent paper out about these issues, and so we look forward to discussing those papers and everyone else's materials. I think there were some 200-300 pages of materials sent, so we've got a lot to digest here, and our panelists will help us do it. Although even after the panels, I recommend folks go and read everyone's submissions: Doug, Larry, Hitesh, and Stan, and our first panel. I want to welcome Doug Sifu, who is the CEO of Virtue Financial. He's a former partner at Paul Weiss, and Virtue Financial is often colloquially described as a wholesaler or an internalizer. So they will have the on-the-grounds experience to help us understand some of these issues. So we welcome all of you. We will have some 10 to 12 minutes of discussion here of opening statements, opening remarks, and then we'll move to a discussion where we'll take questions first from the chair and commissioners, and then from the members of the IEC. IEC members, please let me know in the chat as you jump into the queue, and no reason to wait. Jump into the queue as soon as you can, so we'll have a full queue when we go to questions. All right, Stan, welcome, and the floor is yours.
Oh, well, thank you so much. It's a tremendous honor to be here. I'm even wearing a suit and a tie and even matching pants for the first time in like 16 months. I'm the Chief Regulatory Officer for Decimus Capital Markets, which is a regulatory consulting firm. And I've written extensively on market structure issues, including 2 long law review articles about the best execution obligations of off-exchange market makers or wholesalers. So it's a very relevant topic, of course, for this panel. So let me start off. Second slide, please. So I just want to set the stage for our discussion here. I'm not a data guy. Larry's a data guy, Hitesh is a data guy, and Doug is both a lawyer and a data guy. But I really want to focus on legal and regulatory issues. So, and the first point I'm trying to make here is that the business model of wholesaling, I have those elements listed here. It's been extremely stable over the last 30 years or so, despite technological and regulatory changes. And not necessarily every single element is present. For instance, PFOF is not synonymous with wholesaling. I have this
great quote by Bernie Madoff. And by the way, his market making business was a legitimate one, and it should not be confused with the hedge fund fraud. So, and of course, the division of labor between customer-facing brokers and wholesalers makes a lot of sense. It goes back to the notion of the division of labor by Adam Smith, and probably we don't want to see any vertical integration like Vertubuy and Robinhood or vice versa. And here's a critical point. There is no direct, typically there is no direct customer-broker relationship between wholesalers and ultimate customers, such as retail traders. But the duty of best execution could apply to multiple parties in the execution chain. And legally, there are three reasons why it's so. First of all, a wholesaler could voluntarily assume the duty of best execution. Secondly, there could be broad agency/executing broker relationship, which is pretty much typical. And finally, there is a very sophisticated regulatory framework developed by FINRA. Second slide, please. It's very fashionable to criticize FINRA, but I'm just going to say that it has created a very sophisticated framework. And the reason behind that is that back in 2006, NASD was very much concerned about captive order flow relationships where wholesalers had disclaimed the duty of best execution entirely. And of course, it was a horrible arrangement, a captive order flow relationship with no guarantee of best execution. And there's more historical information here, but going back to what FINRA has right now, FINRA has stated very explicitly that the duty of best execution could apply to different parties in the execution chain, but those obligations are not necessarily identical. And I have a key example here. A customer-facing broker could get away with periodic review, but a wholesaler needs to review each order individually if it's internalized. Next slide, please. In a quick comparison of the regulatory regime in Europe, both similarities and differences are kind of striking. For instance, in Europe, wholesalers, they actually...
All right, I'm going to end the stream at least for now because I've got to do some work for the channel I'm a moderator on. So anyway, thanks for watching. I don't know how many viewers I got, but I might come back later if I can get this stuff done quick enough.